Welcome back, investors, to Ticker Time News. I'm Adam. And the stock market, well, it was confined to a narrow trading range that was until the FOMC rate hike decision at 2 p.m., which fueled whipsaw price action. I mean, it was brutal. The FOMC voted unanimously to raise the target range for the Fed funds rate by 75 basis points, as expected, right to 3 to 3.25%. And it suggested that further rate increases will be appropriate. The summary of economic projections conveyed a higher terminal rate of 4.6% versus 3.8%, which was the projection just back in June, 3 months ago. A lot has changed at the Fed in the past 3 months, really over the past month. That's what really rattled the markets. The initial reaction was a heavy inclination to sell before the rebound effort, supported by falling treasury yields, which took the S&P 500 to the 3,900 level. However, the market ran into stiff resistance right there at 3,900 and sold off sharply into the close, wrapping up the day at session lows. The takeaway from today's rate hike decision, summary of economic projections, and Fed Chair Powell's press conference were that the Fed will be raising rates further and they'll keep them higher for longer. The Fed is committed to raising rates quickly and further into restrictive territory to help bring inflation back down to the 2% goal that the Fed has. Fed Chair Powell conceded that there will be another 100 to 125 basis points of tightening this year. This year, another full percent to a full 0.25%. This year. We only have 3 months left, and there are only 2 more times that the Fed can hike rates, unless they hold a special meeting in October, which I don't see that happening. And Jerome Powell thinks that it's very likely the Fed's fund rate will get to 4.6%, which is the Fed's median estimate for 2023, and presumably the new terminal rate. The equity market and bond markets both had volatile reactions. The action in the Treasury market will be interpreted as a belief that inflation will be quelled by the Fed and the Fed's rate hikes, and a material slowdown in economic activity. The 2-year yield dropped to 3.95% from 4.1%. Yeah, the 2-year cracked 4% today, but it settled at 3.98%. The 10-year, well, it went from 3.61% down to 3.51%. The moves in the Treasury market supported the rebound effort until it resonated for stock market participants that Fed Chair Powell's message has not changed at all from Jackson Hole, where he said restoring price stability will require getting a couple words mixed up here, will require a restrictive policy stance for some period of time. He also said the historical record cautions strongly against prematurely loosening policy. So they're going to hold it higher for longer. And that reminder also rattled the markets. This is not a friendly statement for the economy either, or for the markets for that matter. It's a statement that suggests multiple expansion is going to be easy to achieve at best because interest rates will be headed higher. The uncertainty about how much impact that will ultimately have on earnings growth, along with the uncertainty as to how high the Fed funds rate is going to go and how long it's going to stay there, is exactly why investors will be reluctant to pay a premium for each dollar of earnings. Now, this is bad news for the broader economy too, because a weaker economy will lead to slowing economic growth, slower earnings growth, or no growth at all, which will also, it won't be good for the labor market. If the labor market weakens, weakens, which it's going to, consumer spending will also weaken. And if consumer spending weakens, so too will business investment. And with rates going up, investment's already falling. The cost to borrowing money is going higher, meaning we will have an earnings recession. The late sell-off that ensued was broad-based and indiscriminate. The three main indices all logged losses of at least 1.7%. The Vanguard Megacap Growth ETF, ticker symbol MGK, closed down 1.9%. And the Invesco S&P 500 Equal Weight ETF, ticker symbol RSP, closed down 1.7%. And every 11 S&P 500 sector closed in negative territory, with losses ranging from 0.3% consumer staples or XLP to 2.4% consumer discretionary or XLY. Consumer staples XLP, it was supported by General Mills, ticker symbol GIS, who was up 5.7% in all of this red. And it was able to buck the downtrend after reporting favorable quarterly results. The energy complex also settled mixed. WTI crude oil futures fell 0.3% to $83.84 a barrel. But I'm sure what's happening in Russia right now is not going to help the continued fall of oil prices. That, I'm sure, is going to get worse. President Putin suggested nuclear war? Where are we headed? And I don't even think the market reacted to any of the geopolitical news that was out there today. It was all focused on the Fed. Speaking of the energy sector, we had natural gas futures. They weren't down. They were up 1.2%. I think that had to do with what's happening in Europe. Looking at some of today's economic data, existing home sales decreased 0.4% month over month in August to a seasonally adjusted annual rate of 4.8%, or 4.8 million units. I'm sorry. This has got me all wondering now with what happened today. Right now, the futures market is saying that we could see a red day tomorrow. Things continue to fall after the closing bell. But back to those home sales for just a moment. The existing home sales. I got to finish my thought on this one. And then we'll talk about your questions and what's happening in the market. Technically wise. The expectation from that 4.8 million units was 4.7 million units. So we got a little bit better. But that is the 7th straight month of existing home sales falling. Total sales in August were down nearly 20% from a year ago. The key takeaway is that higher mortgage rates are taking a bite out of existing home sales, having created affordability pressures that have forced some sellers to lower asking price, which in turn is leading to a moderation in the pace of growth in home selling prices. Looking ahead to Thursday, market participants will receive the initial weekly jobless claims. Expectation is 220,000, and that's up from last week's 213,000. Continuing claims prior was 1.403 million. That comes out at 8:30 a.m. Eastern. So, Fed Chair Powell, he made it clear today that the Fed is full steam ahead with policy tightening, which will hurt the economy, earnings, the labor market, and the stock market. Now, looking at where the stock market fell today, it couldn't have been called any better. When we were talking about the highs and lows yesterday, looking right here at the SPX, the big old red candle today. Wow. Wow is right. Wow is right. Let me throw this up here, and then I'll get your other one up there before I say it out loud. Oh, come on. Work for me. There we go. Wow is right. So the market today, the S&P 500 SPX, it got to that 3,900 level, right? When it initially saw that bounce, it got to 3,900, but it was shut down. And it was shut down hard. And that 3,900 level has been persistent resistance. Right here is that line, that 3,900. It also came as support just a few weeks ago. So that was stiff resistance. And if the market couldn't break through that 3,900, then it was bound to fall. And 3,800 was a key area to watch. Now, this gap right here, it got completely filled today. And the candle, the bottom of the candle, 4 o'clock couldn't have come at a more perfect time for this decline, because it stopped literally right at the bottom of that gap. The markets love symmetry when it comes to charting. It's not some sideshow. Technical analysis, it can give you some information if you know what you're looking for. And that's what we try to do. So it went through that 3,800 mark pretty good. Pretty good. It ended at 37.89. And of course, with the futures market, after the closing bell, things just kept falling. So do we have more falling to go? Well, if we do, let me just throw this one up here. Killed it with puts. Absolutely. Puts rang supreme today. Now, this volatility that we saw in the middle of the day, we've seen it before on these exact type of newsday events. So it's not anything new. We were expecting this. We were expecting this. All right, let me get the RSI up here, because as we speak, right, as this market fell today and as it has kind of bounced around so far this week, risk is shrinking when we look to the upside, okay? The reason being, look at this RSI. It is at a 33, okay? A 33. It is 3 points away from being oversold. It has been in a decline, obviously, since we hit this little peak right here, right before the Jackson Hole speech from Jerome Powell. And let me throw this one up as well. You are absolutely welcome. Absolutely. I love you guys. Totally, completely, honestly. All right. With this RSI going down like this, getting down to 33, we are approaching an overextended area, okay? An oversold area. That will lead to a bounce. Whether that bounce happens tomorrow, the next day, it will happen eventually, okay? And I know eventually is not a very good time frame for when this market is going to finally appreciate that. Absolutely. When we look at the weekly expected move here, the bottom end of that is at 37.56, okay? We could easily get to that tomorrow, and that be kind of the catalyst for an oversold bounce. And I know, when we got to this point right here on the chart, where it bounced off of this crazy Jackson Hole fall, continued fall the next day and the next several days, this bounce was inevitable right here because it had reached an oversold point. The RSI got to a 27.5. So that's kind of what I'd be looking for. Maybe tomorrow we have continued selling pressure. But maybe at some point tomorrow, we get down to the weekly expected move and we get a little bounce off of that. That is totally possible. If we look at the very next day after Jackson Hole, right, which again is this candle right here, okay? when we get to this candle, that's Jackson Hole. The very next day, look at that candle right there. That's called a Doji Candle. Almost to the T definition of Doji. A Doji candle is typically a very small body, and you've got equal proportions on the top side and bottom side of the candle body. So the wick is equal on the top, equal on the bottom. Almost perfectly there. In a Doji candle, it can mean different things. For that particular day, since that Doji candle was a little bit more on the downside of where the wicks were, so the wick on the top was a little bit taller, just meant more downside pressure was coming. But look at that candle, how small that candle is. Even though the wick, if we took into account of that wick, let me just back this up here, clean up this chart a little bit so I can make this clear. If we look at that candle, I'm going to look at that candle specifically because that was after Jackson Hole, right? The wick on that candle went from 4,062 all the way down to about 4,015. So that is saying that it is possible that after a big candle like we got today, big red one, we could see another at least big candle form early in the day. But then come afternoon, after the market has realized, oh, well, we've been selling off for a while. This RSI is getting kind of extended here. Maybe it dips to, 29, 28 on the RSI. And then the market starts to bounce. Well, that would leave us with a Doji type star candle. Okay. That could be totally possible for tomorrow. So just be careful about that one. All right. I want you to be aware that that could happen tomorrow. When we look at other big candles selling in that matter, look at this big candle right here. A giant gap down and a big red candle. What was the candle we got the next day? We got a Doji candle again. Doji candles are very common after big moves, up or down. Okay, it doesn't have to just be a red down day. It can be a giant green up day. And then a Doji candle can happen the following day. It can be green, it can be red, but it means that from the open of that candle to the close of that candle, there was little movement. But the wicks, they can move pretty extreme from top to bottom, top to trough. So just be careful. If we do start to see the RSI dip below 30, watch for a rebound bounce. It may not come tomorrow, okay? We may just get a Doji type move tomorrow. Let me back this up just a little bit. Clean this chart up. We'll go look at the SPYs, Qs, and IWM as well. So first thing, make sure that you have 3756 written down if you're doing anything regarding SPX. That is the bottom end of the weekly expected move. And if RSI gets below 30, both of those together, they could trigger a bounce. Because remember, the market likes symmetry. And that is definitely something that provides a little bit of symmetry when that occurs. All right, I want to look at one other area here. Another big candle, okay? Where two of them. I just want to drive home this potential Doji candle tomorrow. Okay, remember when we had this giant fall right here? I mean, boom, 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 all the way down. We had a little rebound and then fell hard again. that last candle right there, it left a slight doji candle beside it. Okay. I just want to point that out. There's one more I want to point out. This big red candle right here, okay? After that big fall, which was a 4% drop in the market, we only fell 1.7% today. But we got a doji candle the very next day. Just trying to point out this potential for tomorrow, because we are getting into an oversold area. Now, here on this 4% drop, RSI was only at a 40. Or not only at a 40. 40 is pretty good. It's nearly right in the middle. 40 to 60, that's a good place to be. So it's not quite down there as far as we are right now. All right. So just want to point those couple of things out here on the chart just to show that, hey, that could happen. Now, if we see a candle that has a big wick on top, and then the body of the candle is more towards the bottom of the wick, then that could lead to a reversal type candle. I'm not thinking we're going to get any type of reversal tomorrow, and whatever type of candle we do end up making tomorrow, there was a lot of the news today, especially the 75 basis point rate hike, that was baked in. All right. It was already priced in. I can go ahead and move this now. But what was not priced in was apparently the markets forgetting about Jackson Hole and what happened there. And of course, the Fed saying we could get to 4.6% on the Fed funds rate. We're only at 3 to 3.25% right now, because there's always that 0.25% swing. All right. So right now we're at 3 to 3.25%. Jerome Powell, the Fed, just said 4.6%. We could get there by the end of this year. By the end of this year. Now, there's something else I want to show you. And it doesn't have to do directly with the market per se right now. But look at this. You guys know that we check this out, especially as we approach Fed meetings, FOMC meeting. This is for the next meeting, which is November 2nd, November 1st through 2nd. November 1st, November 2nd. November 2nd is when we will get our next rate hike. Unless there is some crazy action in October that we get an emergency Fed meeting. But I don't see that happening, at least with the data right now. Thank you for that super sticker. I greatly appreciate that. I'm sorry I didn't catch that earlier when you left that. My apologies. Thank you very much for doing that. Greatly appreciate that. Okay. So what are we seeing here? Well, we're seeing again the probability of what will the rate hike be at the November meeting. And right now, we have a 27.2% of a 50 basis point rate hike. We have a 72.8% probability of a 75 basis point rate hike. So right now, the market is feeling so taken back that it's already assigning a probability of another 4 in a row 75 basis point rate hike. That's not priced into the market, not even close. If we go down here and look at how things were a day ago, a week ago, a month ago, let's just look at a week ago. A week ago, September 14th is when they are counting a week ago. The 50 basis point rate hike was at 31.6%. The 75 basis point rate hike was at a 53.9%. Wow. And then a month ago, 75 basis point rate hike wasn't even considered. Now it is. Now it is. And if we go and look at December, let's see what December holds for us. We'll look at that. Another 75 basis point rate hike. The market has finally started to wake up to the fact that the Fed is not their friend. Not this time around. I know. Every time is different, right? Well, this time really is. Because for the past 14 years, you've heard me say this before, because of quantitative easing, QE, the Fed has always stepped in. I want to go and show you a quarterly view. Oh, hold on. Let me go to the monthly view. And I got to fix this. I just want to show you something. We're going to a monthly view here, okay? Now, typically, the Fed, once there has been a couple of quarters, as a matter of fact, when we go back to, let me get my highlighter. When we go back to this decline back here, right? The 2003 bottom. When we go back to right here, the 2009 bottom. What helped these falls, these pullbacks, these corrections, these bear markets finally turn things around? Well, it was the Fed stepping in with QE. If we look at every other little pullback we have had since then, right? Any little pullback, all of these little pullbacks here that I'm circling, and a couple of these circles have a few of them in it. What has always caught the market when it fell? The Fed promising quantitative easing, buying up and putting liquidity into the market. The Fed is not doing QE. The Fed is doing QT, quantitative tightening. They started in February taking $95 billion out of the market. It just started in February at full force. What is that going to do to the market? It is not going to save us. The Fed said today that they are going to continue hiking rates for longer and going higher. We could be at 4.6% by the end of this year. That will leave this market much lower than it is right now. You take into consideration that $95 billion of liquidity is coming out of the market every month. September, October, November, December, January, just continuing on. That is not going to provide a sustained rally. I'm sorry. There are so many YouTube videos I check in on, I watch. I like to hear what other people are saying. And there have been so many YouTubers wrapped up in the fact that, oh, hey, the summer rally, we're going to the moon. Or even when we bounced right here the first time and we started to rebound back, oh, I told you so, we're going to the moon now. No. $95 billion of liquidity coming out of the market, rates going higher. That's going to slow the economy, which is going to cause the unemployment rate to start creaking up. And when the unemployment rate goes up, like I said earlier, consumer spending will go down. If consumer spending goes down, guess what happens to earnings? Earnings go down too. We're going to see an earnings recession. What do you think the market's going to do when we get earnings growth that is slowing, or earnings that have no growth, that are flat, or maybe even negative? Look, when we go to, let's just go to Q1 of 22, all right? January, February, and March. Okay? Let's get all that wrapped up in here, all right? This is what happened in Q1. But we still had companies that were reporting record profits. QT hadn't even started yet. QT is in full swing right now. If companies who in Q1 compared to Q1 of 2019 saw their earnings, let's just say, increase by, let's just say 100%. I know that's real big, and only growth companies do that. Yeah, well, growth companies are going to get hurt the most. They had 100% growth rate year over year. So from 2021 to 2022, Q1 to Q1, 100% growth rate. Now, let's say from Q1 of 2022 to Q1 of 2023, there's no growth. They come in with the exact same revenue, and let's just be generous and say the exact same earnings. Do you know what that growth rate is? That growth rate is 0% year over year. What do you think a company's stock will do if they say we had 0% growth year over year? When was the last time the market heard that from any company? Well, I shouldn't say any company, right? I'm sure there are several small caps that have reported that. Let's go with big cap growth. When has Apple, Alphabet, any of the big ones, Microsoft, even Netflix, Disney, we can go down the list, 0% growth year over year? When was the last time? I don't know. I don't know the answer to that, quite frankly. It's just a question to pose, saying in 2023 in Q1, if companies have a 0% growth rate, their stock is going to go down hard. And that is something that could absolutely happen. And if it does, well, this market, as harsh as it's been for 2022, is only going to get worse in 2023, unfortunately. With what Jerome Powell was talking about today, I'm not even sure now if I should have even started to sweat the fact that this rate right here, 32.75, is this too low? I don't think it is now. Most certainly not. If anything, Jerome Powell increased my conviction that we definitely have not seen the bottom yet. That bottom is coming soon. Now, if geopolitical action continues to heat up, if Russia doesn't want to behave itself, then that's a black swan waiting to happen in this market. So just want to kind of talk raw and just throw it out there after a day like today, and talk about the, not so much the what ifs, the if this then that conversation. All right, so tomorrow, watch for the bottom end of the weekly expected move on the SPX. That's again 37.56. And if we continue to get an RSI declining, of course, if it drops, the RSI will drop too. If that gets stretched out, oversold, we will see a bounce, because markets don't just move in one direction. They don't just go straight down or straight up. So just remember that. That could initiate some sort of a short-term bounce. Even again, create a doji star type candle, right? Greatly appreciate that. I try to be honest. I try to do my due diligence. I try to do my research. So when I come out here on a public forum like this, doing it live, no cuts, none of that stuff, I just want to make sure that I am providing you with the most accurate information that I can. So I greatly appreciate that. I really, really do. All right, let's look at the SPY, the Qs, the IWM, and then if you have any questions, feel free to get them in there. I know it's kind of raw, a feeling like this for a day like today. I know many market participants did not participate in this market. As a matter of fact, volume today at the New York Stock Exchange was light. And that tells me that your big traders, a lot of them weren't involved today. And another thing that you have to remember is that the market moves in cycles. And I know that it seems crazy looking at 2022, but markets move expansion, contraction. You've heard me say it a million times. Contraction is when the market is digesting new information, right? The market will react, it will overreact, and that'll be your expansion. Your big move up, your big move down. And then at some point, the market has got to digest whatever that new data was. And that's when you contract. And it's honestly, it's been hard to kind of find some of those patterns this year, because things have just been up and down and up and down and just whipsawing around. So again, I'm just trying to say the market has been down quite a bit since the high reached right here, September 12th, this high right here. If you look on the SPY, SPX, Qs, IWM, it's been a pretty big fall. As a matter of fact, if we measure that on the SPY, from that point to today, that's been a 7.8% decline with hardly a rebound. I mean, I really wouldn't call what happened 2 days ago a rebound. It was one green day, right? We ended up being flat all week minus today. So I wouldn't take what happened right here, this green candle 2 days ago, as a rebound. It just happened to be a green day in this declining market that we've been in. We are way under that 5-day EMA on the SPY, And whenever we get disconnected from that 5-day EMA, that's when you start to see the green days. Okay? Let me blow this up here. Give me just a quick moment so I can open this up some. Almost got it where I want it to be. Almost there. All right, everything been working fine. Now it's starting to give me a delay. Come on. Okay. So the blue line. This is the 5-day EMA. It ran up like this, and then it was a quick fall. I'm trying to stay as close to it as possible here. And here we are. Okay. Now, price action is all the way down here. Whenever price action moves away from that 5-day EMA, it wants to reconnect. Think of this as like a circuit where you'll always have to be connected to that 5-day EMA. On the SPY, the 5-day EMA is at 384. The SPY closed at 377. Our last in this line, this downtrend, this current downtrend that we're in, the last big downtrend, which would be this candle, I'm going to point up to this one right here. It got big time disconnected from that 5-day EMA line. The next day, we had a Doji candle. The wick reconnected with the 5-day EMA, and it was a big moving candle, a small little body right in the middle. I know I'm cluttering up the screen there. Then after that Doji candle, we had another red day. However, I got to add, the wick reconnected with the 5-day EMA, but it was still a down day. Then we had this giant gap down, disconnected from the 5-day EMA again. The next day, we rally up, we reconnect with the 5-day EMA. Yesterday, we disconnected. Today, we got further of a disconnect. That just means, to me, that the chance of a bounce, I think, is increasing. I know we got horrible news today, and we could see another horrible red day tomorrow. But it's not likely that we stay disconnected from that 5-day EMA. Look back here. Okay, let me show you one more example, and we'll go look at the cues. Let me open this up some. I'm looking at middle of the screen here, Jackson Hole. All right, Jackson Hole, right? And then we just line up that 5-day EMA. And this looks like a snake curl and not a straight line. Okay, so Jackson Hole got disconnected. Doji Star candle the next day, still disconnected. Then we had a red day, but we came back up. We connected with the 5-day EMA right here, but then we still had a red day. Another red day, but the wick came up. It did reconnect with the 5-day EMA, but it was a red day again. Then we had this gap down, right? The wick goes down even further. A green candle coming back up because we did not reconnect with the 5-day EMA. There was a gap up to open the next day back above the 5-day EMA, but still sold off. Okay, so you can have many red days in a row where you are down in the market, and it can be pretty deep. This was a 1% day down. This was a 0.8% day down. But the wick or the open of the candle reconnected with the 5-day EMA. So this is very important when you're trading, to understand where you are in relation to the 5-day EMA, because that can dictate gaps up, gaps down, how far a candle or how far you may rise intraday versus how far you may fall intraday. Because constantly, these candles want to stay connected. Again, it's like a circuit. They want to stay connected to the 5-day EMA in some way, shape, or form. I probably should have led with this talk right here. But again, I'm just kind of keeping it raw today, and just whatever pops into my head, that's what we're talking about. Except for the opening part where I really talked about what happened today. Okay. All right. So on the Qs, I'm sorry, on the SPY, we're still on the SPY. Again, the lower end of that weekly expected move, 373. 5-day EMA is at 384. And the RSI right now is at a 32. So again, we could come down, we could tag the weekly expected move, and then maybe rally back up to try to reconnect with that 5-day EMA tomorrow. That's a possibility. Okay, going to the Qs. And if you do have any questions, just plug them in. We can talk about them. Otherwise, I'm going to do the Qs, the IWM, and I'll probably wrap it up there. I know it's exhausting after being in a market like this today. Okay, especially with all the news. All right, so the lower end of the weekly expected move for the Qs, 278. The 5-day EMA is at 288. The RSI is at a 33. So we are 3 points away on the RSI. Again, could see the same thing. We are disconnected from that 5-day EMA. We could come down, get close to the weekly expected move, 278. And then we could bounce from there, right? We are getting overextended. And the daily expected moves that we're working on, I call them the experimental daily expected move. It is basically showing you what risk looks like on each day for the different indices, the different sectors. And right now, on the SPX, risk to the downside is shrinking while reward to the upside is growing. It's nearly a 1% risk to the downside versus a 7% reward to the upside on the SPX right now. And that's using the same options market data and the word slipped my mind, equation that we use to come up with the weekly expected moves. Same thing, except for on a daily time frame. So the SPX, again, that risk is a 1% to the downside versus a 7% to the upside. So risk to the downside is shrinking, reward to the upside is growing. And that's just telling me we're getting closer and closer and closer to some sort of a bounce. Okay? Again, not saying it has to happen tomorrow, but the likelihood of it happening is increasing as we move forward in time and we continue to move down. If we go down and close in the red tomorrow by another percentage point or whatever it may be, then that's just going to cause that risk to shrink even more and the reward to the upside to grow. Okay? So what that is also saying is if you're playing the options market, if you have a 1% risk of going down, well, no, let me change that. If you're playing options and right now on the SPX, if your downside risk is at 1% and your upside reward is at 7%, would you want to short at that moment in time? No, you would not. That's where you would want to start looking for some sort of a bounce, either hedge your shorts or play some short type of a short time framed long position, right? To catch that bounce. It's inevitable. It will happen. As a matter of fact, let me hop over here. Let me pull. I'll give you what I usually never talk about these on the channel here. I keep it for our private community. But I just want to tell you what the risk and reward is right now for the Qs as well as the SPY. Just takes me a second to pull it up. Bear with me. Almost got it. I guess you shouldn't keep your stuff in the cloud when you're doing a live stream and then try to get to it. Unless you've got a PC, right? Oh, come on. Just want to get to it real quick. Almost there. Oh, come on. Almost. I see it right there. Okay. All right. For the SPY, the downside for the SPY tomorrow is down 0.77%. The reward or the upside is sitting at 8%. So that is not a position you would want to be in to open a short position for the SPY. For the Qs, tomorrow, there is a 1.42% potential downside versus an 8.58% to the upside. Again, that's not a place where you'd want to open a short position. That's a place where you'd want to start looking for a bounce. And then the IWM. Let's go ahead and open up the IWM over here. And again, this is like the weekly expected moves. It's created based off of the data from the options market, goes through a formula and out pops the upper end and lower end of the expected move with the what are you looking for downside versus what are you looking to towards upside. So for the IWM, we are at the bottom end of the weekly expected move is 172. The IWM tomorrow, September the 22nd, we have downside risk at 0.93% versus upside reward of 7.26%. So again, that's not a place where you'd want to go and open a short position. That's a place where you'd want to start looking for a potential bounce. So I just want to say that risk to the downside is shrinking while reward to the upside is growing right now. And it's the difference between the two has only gotten greater with today's drop. So I hope I'm saying that so you understand what I'm trying to get across here. I hope it's coming out okay enough. Just running it through my mind, sometimes I'm not sure if I even can get the message out there clearly enough. Yeah, I was thinking the same thing. This market has here, let's put it up on the screen. Yeah, I was thinking the same thing. This market has had no bounce since Jackson Hole. Well, it's had a little bounce. Jackson Hole was back here on this candle. So we had this, 5-session bounce right here. But yeah, I totally get your sentiment there. It's been a month with really not a whole lot of upside. Totally get what you're saying. And if you look here, let's do this. Let's look at, on the IWM here, if we look at, let me take these two marks off. And if you look at the RSI, going back to the peak right here of the summer rally on the RSI, I mean, we've just been trending down, right? These are lower highs being made on the RSI. And looking at price action also, I mean, you know, we've got the summer peak there. We've got a lower high, and I'm sure whatever bounce we get will be another lower high. And we've got a lower low, and a lower low. We are trending down. There's no mistake about it. Since the summer rally peak, lower highs, lower lows, all the way. RSI trending down. MACD trending down. Okay? So even if we, I shouldn't say if, even when we get a bounce, I highly doubt that it's going to make a higher high. Again, I'm sure it'll make a lower high, and then we'll make another lower low off of that as well. Maybe after, see, the Fed meets again, or the last Fed meeting for 2022 is December 13th and 14th. So maybe it's possible we could get a Santa Claus rally. Maybe the Fed comes out on the 14th of December with a rate hike decision, and then maybe we can see a 2-week rally there through the end of December, or the last trading day of December. That's a possibility. But the market doesn't always go in the same direction. So at some point, we are going to see a bounce, and the risk is shrinking, and the reward is growing for an upside move, for a bounce of some sort. All right. I think that's everything that I've got right this moment. Just want to say again, don't try to short it right now. There's this old saying, how is it? What is it again? Don't short in the hole. We're already in the hole. We've already been, trending down now since the peak, August 16th. So for over a month now, we've been trending down. We've had a bounce, which I'd call August the 24th and the 25th. I would call that right there. Those 2 green days, that's a little bounce. That's kind of like what I'm expecting after we, maybe we sell off even more tomorrow. And then we had a little rally here at the very beginning of September. I guess it's possible after the midterms, maybe we get a little relief rally going. But I just think geopolitically, it's just going to continue to get worse until the midterms. You got Taiwan and you got Ukraine, China and Russia. Doesn't look good either way. So yeah, expect some kind of a bounce in the near term. Don't short in the hole. This is not where you want to go short on equities here. Okay, there's spam in the chat. Ignore that spam comment, because I didn't help with him getting 2 Bitcoin. Oh, man. Okay. Let me just throw the dollar up here and say one other thing, too. When it comes to the equity market, a lot of time crashes. Yeah, we've got bots. Yeah, we got bots, too. Don't leave us out. We've got bots, too. Oh, the whole, is YouTube giving you a notification that this video is going live? I know for me personally, for a couple of channels that I regularly watch, I haven't been getting notifications, or they've been sparse on notifications. One way around that, obviously, we have a Discord now, of course. The notification, if you have the Discord app, it's pretty spot on. I haven't seen a Discord miss a notification yet. And that part of Discord is public. So you got that. Or I literally get them after the stream ends. Yeah, I don't know what's going on with YouTube and those notifications. Maybe the content here is too spot on. The Fed doesn't want it out there. I don't know. But you can also be the notification. If you get the video, share it. That obviously helps, because then you become the notification. So I try to make sure that I'm sharing the link to this publicly. So at least there's other ways to go about it besides just having to rely on YouTube. So point that out there. And then the thing I want to say about a market that is falling, that has been falling, a lot of times the biggest crash in the market, a big down day, can come when the market is overextended to the downside. So, excuse me there. So don't forget that little tidbit as well, because that can absolutely happen. The dollar, it was strong again today. Look at this thing, up a full percentage point. It's closed at 111.35, and it's at 111.60 right now. It's only going up. A rising dollar is not good for multinational corporations. It hurts their earnings, right? So that can lead into earnings also coming down. And I expect this dollar, when it does reach its conclusion, it may just happen on a blow off top, where this dollar just runs. We have capitulation to the downside on all the main indices, many stocks, just full blown panic sell. Capitulation, I don't think has happened yet. I don't think we've seen capitulation yet. Typically, capitulation occurs. Let me go to the VIX here right quick, and then this will be, that was the wrong ticker. VIX, not Visionary Gold. All right, Visionary Gold, it was actually green today. Okay, VIX. I want to point this out. I'm going to go to, let me fix this real quick, and this will be the last thing I talk about. You can see the VIX, it got out of its during the summer rally. It broke out on the downside here, but it has been back in that trading range, that wedging pattern there. So I'm keeping that on my radar. But in past bear markets, capitulation, when you see capitulation, this is capitulation right here in the middle of your screen, okay? A spike like this is capitulation. And this was COVID, March of 2020. That's what capitulation looks like. When everybody's just sell. That's capitulation. We haven't seen that, right? We can go back here to 2018. 2018, we had a period of capitulation. We can go back further, and it doesn't last long. Capitulation doesn't last long. It can last a day or two, maybe three. But usually by, the start to the end of the week, it's over with. Here in 2015, another capitulation event, right? When the market moves down at a rapid pace. Let's go back even further here. See, capitulation on the VIX, VIX is the ticker. Use the CBOE. Here again, right here, this happened on a this is the 2011, 2012. Here's the 2008, 2009 capitulation right here. Really, you need to see the VIX get to 45 or higher. And that is capitulation. And it has to be in a shortened time frame. Like it goes from 20 to 40 to 45. That's capitulation. And we have not seen anything in the 40s yet this year. Okay. What's the highest we have gotten so far? Might be 30, 35, 35, 35.8 is the highest we have gotten this year. 45 or greater, that is true capitulation. That's how you know. So keep an eye out for that. I don't know if we're going to get that anytime soon, but that's typically when you find bottoms of the market, right? Long-term bottoms of the market, like the absolute bottom. So keep that on your mind. All right. I'll wrap it up here. I told you risk to the downside is shrinking, reward to the upside is growing. So that means don't short right now. If you're already in a short, we get to the we get closer to the bottom end of the weekly expected move. You can take some profit there off the table and then wait for a bounce and then reload your short position. But stay cautious out there tomorrow. I'm sure we'll probably get, I mean, I'd probably expect a gap down tomorrow morning. But we are due for some kind of a bounce. Whether, again, that happens tomorrow or Friday or next week. Doesn't have to happen tomorrow. But we are getting down there. All right. Now I just sound like a broken record, right? All right. So we're good on questions. So that's good. I've said my piece for what I wanted to say today. So that's good. Let me just say that we sent a whole bunch of information out to our private investor community today. If you would like to support the channel and get some cool stuff along with it, click the first link in the description. Click the second link in the description to join our Discord server. And hopefully we will all have a wonderful day tomorrow. I know most of us did, I'm sure, really good today because, you know, we know that we haven't seen the bottom yet, and puts usually work really well when you're in a bear market, and we are. So thank you so very much for being here with me. I greatly appreciate it. I'll be back here tomorrow after the market closes to talk about what happened, why it happened, and what to expect going forward. And if you're on the private investor community, again, first link in the description. I'll see you, or I will talk to you, write to you, whatever the case may be, tomorrow morning. So thank you, and have a good evening.